this is Jim Hitt with American IRA. Thank you so much for joining us. We're going to talk today about the secrets to private lending and borrowing using your self-directed IRA, and how to do some of the due diligence. Obviously, when you're doing your due diligence, you have your professionals, your realtors, your advisors, your CPAs, and your attorneys. However, this will give you a point of reference that you can deal with when you're dealing with your professionals. American IRA is a third-party administrator for New Vision Trust Company, and the custodian, which is a South Dakota chartered trust company that I founded in 2017. We have about 700 million in assets under administration, and currently have thousands of clients in technically worldwide, but primarily in the United States. And one of the things that we offer is good solid fees that are reasonable for our clientele, and helps you build your retirement account without spending too much money in fees. And we specialize in self-directed plans, and we make you feel like the local bank. When you go in there, we know the information on your account. We also will pick up our phone and talk to you, unlike the phone trees that you may be familiar with some of the various companies that you deal with on a day-to-day basis. We try to make sure that you're talking to a real person that can take care of your real needs. As I mentioned, the fee structure, for example, $200,000 account, $285 per year, and some of our other competitors are charging twice that amount of money. So as you can see, when you're spending twice the amount of money in fees going to your custodian, then that would, of course, eat into your retirement plan. I'm not going to spend a lot of time on this, but we'd love to talk to you about it when the time is right. We have a 4.7 rating on Google, and a 5-star rating on and an A+ accredited on BB&T, BB&B. BB&T is a bank here in North Carolina, or was. So we're going to be talking about secured loans and unsecured loans, and what the difference is, both the rewards and the risks that you have to be familiar with, and how to mitigate the risks that you may have in private lending for both types of loans. So an unsecured loan is when you are lending money to an individual or a company. And the nature of it being unsecured means there is no collateral. So the only recourse you have is to make sure you have a solid borrower. And when the loan is made on an unsecured basis, the money, the use of the money is not relevant. So it's not to purchase a piece of real estate, to buy a car. The money can be used when you lend money out to on an unsecured basis for any reason that the borrower wants to use it. Trip around the world. So that's one of the differences between collateralized loans and collateralized loans. With collateralized loans, it's a specific loan to buy a specific piece of collateral. Real estate is the most common that people will be familiar with. Now, when you're lending money to a company or a person, it is collateralized by whatever assets they want to put up. Once again, I mentioned real estate, but it could be business equipment, it could be an automobile, it could be any one of those types of collateral. But we're going to talk about real estate here, which is the most prominent use of self-directed IRAs to make loans. One of the things that you must have is a promissory note. This is what we require as a minimum to act as the custodian for mortgages, loans, or whatever type of state you're in. The second thing is a deed of trust or a mortgage that's specific to your state. In North Carolina, it's a deed of trust. In South Carolina, for example, it's a mortgage. So you need to check with your local attorneys and to find out what the type of deed is if you don't know, or look it up on the internet. Transactions should occur with escrow, title, or closing. It says should, but it must. The closing without an attorney or a title company or an escrow is extremely challenging for many or most people. And this way, you know, when it closes, that you have a properly recorded deed of trust or mortgage, you have a proper closing statement, And then that collateral information is sent to American IRA for the benefit of your account. Now, those are must-haves. The should-haves are hazard insurance and title policy on the property. Think about it like this. You buy a piece of real estate, closes at 9 a.m. on today's Wednesday, and you don't get title, you don't get hazard insurance. Property burns down at 10 o'clock. Well, if you don't get fire insurance and hazard insurance, then you have no collateral, you have no property to secure your loan other than the lot that the house was previously on. So me personally, I don't believe anybody should do a loan without hazard insurance and fire insurance, but that is not something that is required on our documents. It's something that you have the choice of, and we highly recommend that you do that. Title policy on the property, similar conversation as with hazard insurance. Title policy says that when you make the loan, that you have made the loan on the right property. So in other words, 123 Main Street, the title policy says 123 Main Street does not have any other loans except the loan that you are making. So you would be in that case first position. If you were making a loan in second position, it would say 123 Main Street, a loan to Bank of America. Balance is not on the title policy, but the balance of the on the title report is they say 50,000, property's worth 250,000, and you're loaning another 50,000. Now that would be in second position. Okay. So in the event that you do make a loan that is in second position, you want to verify the balance and the loan to value, as we're going to talk about later, so that you know that you're not making a loan beyond the what's called the combined loan to value for your for the entire property. Now, we talked about different types of loans so far. We talked about an unsecured loan. So scenario one, the borrower performs, you receive your principal back and interest. Now that's the result we want. We're not in the business to make loans to not get paid back, or in the case of a secured loan, to have to foreclose on a property. We want to be a semi-passive investor, collect our interest, and let the active investor take care of the property, which would be the borrower. Second is the borrower does not perform. And then, of course, we have to deal with what do we do then? Well, we have an unsecured loan, which is the second line down, and it says your money is not tied to collateral, so it's good luck recovering your dime. And what I mean by that is it's really simple. When you make an unsecured loan, the only way to collect against a company or an individual is to go to court, which is a time-consuming, costly proposition. So when making these loans, you must consider your risk and your reward of making an unsecured loan, how you would get the money back, and if the person that's borrowing the money has the resources to pay you back if whatever reason they're going to borrow the unsecured loan does not work out. Okay. So as far as a secured loan is concerned, now that's less problematic in terms of getting your money back if you've done the proper due diligence on the value of the property. And we're going to talk about how that looks in doing your due diligence on that in just a few slides. So what you can do is you have the collateral on the property, so you have to foreclose. And depending on the state, in North Carolina, that's it's a filing of a notice of default, and then it's a process of about 4 months to get your money back. For conversation purposes, in South Carolina, that's a mortgage state that can take a year to get your property back. So in both cases, the risk of a secured loan is the buyer or borrower, could in fact file for a bankruptcy to delay it. That's something that is part of your analysis for the risk-reward ratio for making a loan. And that's something that each individual lender has to make a decision for themselves on the quality of their borrower. American IRA and New Vision Trust do not do due diligence on your loans, nor do we make recommendations. So that's the responsibility of you or your advisors on this particular transaction. And as I mentioned, with an unsecured loan, it does not matter what the borrower used the funds for. It only matters if the money is secured. So as you can tell, the theme here is we or I personally look at it as saying it's better to do a secured loan than an unsecured loan, but we do handle both. Now, the collateral, we're going to get into the part of what we would call the due diligence portion here. The collateral is the most important part. What is the value of the real estate? We're going to talk about that. And the second thing is the borrower. Is the borrower a person or a company? Are you going to require financials from that person or that company? Okay, are you going to require from the company a personal guarantee by the principals if you're going to make the loan, so that they are responsible for repaying it personally? These are decisions you have to make for yourself with your advisors. The collateral. Now, for a piece of real estate, let's talk about something for easy math. $100,000 house, and you're being asked to loan $50,000. The question becomes, is it really a $100,000 house? So what you do is you have you do an analysis based on the properties that have sold in the area. You can do that through realtor.com. You can do that through Zillow. You can do that by having a realtor do a market evaluation for you, and then you can go the full range of value by actually ordering a professional appraisal. That, of course, takes longer, and many times in a situation where the borrower is buying a property, they're buying it on a short-term loan, like typically we see as the investors make. They're looking to buy this property at a discounted rate, and so the time is of the essence. So sometimes an appraisal is not necessary, so not available in the time constraints. So making sure you understand how to do comps, or making sure you work with people that understand how to provide an analysis on the value of a property is a key part of your team when you're making these loans. At the very least, you want to get the sold comps that are similar in the last 6 months. And you want to, as I mentioned, verify how much the property is owed on the property through title insurance, making sure there's nothing outstanding. Now, if it's going to be a property where the borrower, and this is a vast majority of the private lending, the borrower is going to borrow the money to fix up the property. Now, so back to the $100,000 property. Well, $100,000 property, is that going to be the current value, or is that the after repaired value? So in this particular case, we're going to talk about both. So if the borrower is just wanting to get some cash out, $50,000, 5-year loan, whatever percentage rate, 10-year loan, whatever the case may be, then that simply, is it worth $100,000? Well, so you're loaning at 50%. Many people consider that a good loan to value for making loans. Typically not greater than 70 for real estate conversation. So that's a fairly easy analysis. Is it worth 100? Well, generally, not always, the people borrowing short-term loans want to fix the property up, and they want to resell the property, better known as fix and flip. So you borrow the money, and as a lender, in most cases, this $100,000 house, if the person is wanting to borrow $50,000, number one is, does that include the purchase price and the fix-up costs? If not, then how much is it going to cost to fix it up? Maybe they need to borrow $70,000 or $65,000. And you want to make sure that they've done their due diligence on how much it's going to cost them to fix it up. Is the borrower giving you these numbers, or is it coming from a contractor? If you cannot walk through the house, have somebody do a FaceTime with you to go through the house, or send you a video on the house. And there are people that can be hired locally to go do this for you as a lender. And as a side note, if I'm going to make any loans out of an area that I can drive to, I'm going to put the responsibility of paying for that person doing the walkthrough for me on the borrower. Many people will pay for it themselves, but that's just me personally. I'm just sharing with you philosophically. If somebody's going to borrow my money, then I'm not going to be paying to lend out my money. Number two, the borrower is an individual, LLC, or corporation. If it's an individual, make sure that in the loan documents that it says this is for investment purposes only. Then that keeps you from having to deal with the Dodd-Frank Act, which has very specific rules for owner-occupied properties. If it's for a business loan, then you don't have those rules, and you're not going to be violating any Dodd-Frank specific situations. And that's all I need to say at this point. You can look up the Dodd-Frank Act on the internet. If it's a company, okay, how strong are they? Have they done any deals previously? And I would do the same thing with an individual. Are they experienced? If they're experienced, then, you may want to loan 65 or 70. If they're not experienced, maybe you want to be loaning 50 to 55. Those are all business decisions you have to make based on your risk profile that you're willing to accept for being a private lender. How many deals have they done? 3 or 4 deals, and they likely have it down pretty good. Verify it on the county records. That's part of your due diligence. If somebody says to you, I've done 5 deals under this name of my company, then it should be pretty easy to do a title search if they've owned the property. If they didn't do the 5 deals, then that would be something you might want to consider prior to making the loan. And as I mentioned earlier, are the principals of the corporation of the LLC willing to do a personal guarantee for your debt? Once again, these are my opinions, not anybody else's. I would want them to do a personal guarantee. But that's up to you as how you want to do your private lending business. Will the borrower share their financials? Now, from a practical standpoint, once again, it's my opinion. If they would be great if they share their financials. The stronger they are, generally, they're more than happy to share their financials. The more medium they are, they're probably beginning, and the financials would mean a nominal amount anyway for your decision. But the most important thing is the collateral. Can the collateral cover the debt? If you, worst case scenario, you have to take it. That's what I particularly look at. I don't necessarily discount the financials. I only look at the collateral. And then do they have cash flow? That's where your financials would come into. Like, how would they make the payments, or how are they going to make the payments during the period of time that the loan is out? A couple of different things. Number one, they've got jobs, so they can do that, make the payments. So you want to verify that. Or two, many private lenders will loan them the money or defer the payment from being due on a monthly basis. So if it's a 6-month loan, they let the payments accrue, and then the interest is paid off at the end. Okay, and then I personally, I've access to pulling credit, so I would pull a credit report on them. And the reason that I would pull the credit report on them, since I have access to it, is it's not going to change the collateral situation. But one of the things it will do is if the particular company or person has any form of liens on them, judgments, tax liens, or anything like that, then that potentially could attach to the property, which would affect my collateral. So that's the purpose of pulling a credit report. Now, I just mentioned this, but option 1 is straight interest. Borrower pays interest and points, and then at the end of 6 months, they simply pay you off. Or it could simply be monthly payments for 6 months. It could be 12 months. I'm not telling you how long the loan needs to be. That's between you and the borrower. But it's interest only monthly. So you got $100,000 loan at 1% interest is $1,000 a month, for example. At the end of 6 months, they would owe you $6,000 in interest. And any points that you would charge, points are a matter of negotiation between you and the borrower. They're not something that we dictate. My purpose of this webinar is to give you a slightly different overview of A, how to be a borrower, and B, how to be a lender, because you're going to have to deal with these both sides, and see some ideas of what to look for when you're doing it. If it could be done by your own funds or through your IRA. And obviously through the IRA, that's much better because you do not have to pay taxes on it until you take the money out when you're 59 and a half or above, or in its case of a Roth, you never have to pay taxes on it, which obviously is a great way to make a loan. Option two is you can borrow or you can lend with your IRA, 401k in a partnership situation with other retirement accounts or individuals. We're going to talk about individuals on the next slide, and then you split the profit. So I put up 50,000, you put up 50,000 through your IRA, not me as a custodian, me as an individual. Put up 50,000, you put up 50,000 to your IRA. I get my share of the profit, you get your share of the profit. So at the end of 6 months, we get our interest, which I mentioned to you, 6,000. I get 3, you get 3, and we get our principal back. Not too bad for a short-term loan. And then we split the profits, which is what I just talked about. So option 3, there is a thing called a participation note. It is where I will, instead of loaning you the money at 10%, I will loan you the money, or 12%, I will loan you the money at say 6%, but I'm going to keep a portion of the profit for taking less interest. So at the end of 6 months, you would only owe 60% of the $6,000, $3,600, and or half of that 3,000. Excuse me. You owe $3,000 instead of 6,000, and then if because I'm going to be part of that profit center, you make 20,000, I'm going to get 4,000 as say 20% profit for my back end. Now, keeping in mind, 20% is not a set factor. The interest rates are not a set factor. Those are a matter of negotiation between you and the lender or your borrower, if you're the borrower, if you're the lender. So I see quite a few of these, and they can be quite lucrative for all parties. If there goes a little bit less money than what you're expecting, then you don't pay out as much interest. If the lender makes a little bit more, then it was a good deal for them. So it's a matter of negotiation. So keep in mind, we don't make recommendations of that or how to structure these. These are simply negotiations between you, your borrower, or your lender. Partnering with real estate notes. Partnering is a great way to get involved with lending with an IRA. Let's say you've got a $10,000 IRA. Okay. Well, clearly $10,000 is not going to be enough money to loan on a typical piece of real estate, the $100,000 example I gave you. And by the way, this is a current recording. I do understand $100,000 is very hard. You can't find a house in Germany. So I'm just using that for math purposes. So the proverbial $100,000 house is you can partner with making these loans. For example, I have a $10,000 IRA. I know somebody else that has a $20,000 IRA. That's 30, and we need to loan $70,000 in this house for this particular borrower to buy it, fix it up, and then so we need to have a $40,000 from somebody else, and that somebody else is not an IRA or not a 401k. It's outside monies. So we together, me with my IRA, my other friend with an IRA, and this third person who is an associate or a friend, will make you the loan for $70,000, and the three of us are going to split the profit. It's a great way to get a small IRA to earn income at a higher rate than basically any other way to do it other than tax liens, which this is not particularly about. So if I make, if the loan's for 12%, I'm getting 1% on my $10,000. I can't do it at the bank. I can't do it in the stock market. I can't be guaranteed of it in any other place. And even with a loan, it's not guaranteed, but there's a high probability that with the collateral, you'll get your money back. And certainly I'm not going to get points if I buy something else. So, 2 points, let's say for conversation purposes, I get $200, 1% interest per month, I get $100. At the end of 6 months, I've got $800 on a $10,000 investment. Now that's a very, very good return in I would say almost in most cases. So that's something that partnering will help you. And that's just a matter of letting people know that you're willing to go in on private lending. There are lenders in your groups, your clubs, your people that you know that would be able to participate with that. You can partner with anybody you want to with your IRA or 401k, except disqualified parties. So I mentioned earlier, I used the word I, okay? And I clarified that I, the custodian, was not what I'm referring to. I'm just talking about as an individual. I, the custodian, cannot partner with my clients, even as an individual, with their IRA, because I am disqualified. So we're going to have other disqualified persons we're going to talk about in a minute. And we have disqualified people and we have disqualified entities. So you can see where you're a you over there. It's your spouse, your parents, your grandparents, entities you or your lineal line owns or controls, your children, your children's spouses, your grandparents, grandchildren, and the grandchildren's spouses. So you can deal with your cousins, your aunts, your uncles, brothers and sisters, but you cannot deal with this group of people. And then there, even with the people that I mentioned, like brothers and sisters, you still want to be careful in making sure that it's, that they don't fall in a disqualified category by you having, for example, a handful of other investments with a particular brother or sister that could put them in a potential to become a disqualified person. But this is the general conversation here in terms of what a disqualified person. Anybody else that's not in this grouping is not a disqualified person, and you can do business with them in whatever respect you want. When we talked about partnering, I want to make sure that you understand you can partner with these people at the time of acquisition. So let's say you've got a spouse has an IRA, you have an IRA. Well, you and your spouse can split in any format. It could be a 70-30, 80-20, 50-50 in terms of how much cash you have in your accounts. But you must do the funding at the time of acquisition. So I have 50,000, my spouse has 50,000 to make this 100,000 loan. I cannot put my 50,000 in and then have my spouse come in and put the 50,000 in afterwards. Okay. So, but I can do it at the same time. Now the catch is you must split all profits. You must split all expenses according to how much you invest in the project. So if it's 50-50, if there's cost, then it must be split 50-50. If there's income, it must be allocated 50-50. That's the catch with dealing with disqualified people. Now, non-disqualified partnering, there's a lot more flexibility. I put up 50,000, somebody else puts up 50,000, but I agree that, because they're doing something else to the property, my IRA agrees that they're doing something else to the property, maybe they're working on it or whatever, they're non-disqualified, then I'm going to give them, or we're going to agree that they're going to get 65% of the return, whether it's a lending and or it's a split of ownership. So that's the difference between dealing with a disqualified person or dealing with a non-disqualified person. Maximum flexibility. You can basically make any kind of agreement you want to, as long as it passes what the Internal Revenue Service would call the smell test. You can't put up a loan at zero interest to this person and then not take anything back, because obviously there's something going on that would not pass the smell test with the Internal Revenue Service. Nobody makes loans for 0% interest in a business-like manner would be the Internal Revenue Service's take on it. So you can split the profit, and it does not have any split. You can split the profit disproportionate if you want to. As I mentioned, disqualified persons, entities, and partners. We talked about that already. Previous slide, but basically you must split it according to the capital invested. If you have a return on capital. The return on capital has to be provided to both. It can't be provided to one. So if you've lent money out and you've made the deal through an LLC, for example, and the LLC, you cannot send the interest back to one party without sending the interest back to the other party's IRA. So that's what I mean by exact. The transactions and the process to opening an account is extremely easy. The operation is easy. You open your account and fund it. You open an account with a set of paperwork. You fund it with either a contribution, a rollover from a 401k, or a direct transfer from an IRA. If it's an IRA transfer, we send the transfer form that you sign to the current custodian. You will need to monitor the transfer from your current custodian to make sure that they're diligent in doing that. We follow up, but we find that if the client helps, it moves it along a lot faster. And then once the account's funded, and during that period of time, you select the investment, get your paperwork ready to go. By the time the account is funded and the checks have all cleared, then you're ready to make your investment. We assist you with your documents. We help you work through it. We don't fill out the documents for you. That is the responsibility of the client, because you know your name, you know your social security number, you know all the information of your previous custodian, and so consequently, there's not much we can add to it. We do give information on how to fill it out. However, we're very, very proactive, but we just can't fill it out for you. The IRA and the 401k lends the money on the property, and you are listed in the public records as New Vision Trust custodian for the benefit of John Smith IRA or 401k. And then the property sits there in your IRA collecting interest, collecting rent, whatever the case may be. In this case, we're talking about a private lender. And then when you're ready to pay off or get paid off, you send us the information, notify us that it's going to be paid off. And then the cash goes back in your account, and you're ready to do it again. So, and take advantage of the compounding effect of 12% money. So we've got the usual suspects, our social media. We've got newsletter updates. We've got a continuing flow of educational material, and certainly you can pick up the phone and call us any day that you want to, from 9 to 5 Eastern Standard Time. And 99.99% of the time, you are going to get a live person on the phone to help you. And I appreciate that you took your time today to listen to this presentation. It is being recorded, so we will send out the recording to the folks that have signed up. And I hope that it helped you with some information on how to be a private lender. And if you flip it over, my parting thought is, if you're going to be a borrower, you've got to be prepared to share or provide this to the people you want to borrow money from, whether it be through their IRA or through their own private funds outside of their IRA. So I appreciate it, and thanks so much for your time today. And we'll sign off for now. If you have any questions, once again, call our office. That's 828-257-4949. Thank you so much.